It's New Year's Eve 2019. You drink a little too much and you pull a Rip Van Winkle. You fall asleep for about 6 months. When you wake up and you start walking around, you see people wearing a bunch of masks. Well, most people. Instead of shaking hands, you see people doing elbow bumps. And you see people trying to avoid each other. The streets are just empty. And so then you go to the internet and you read about the coronavirus and you start seeing all these headlines. You see that we're approaching almost 170,000 deaths in the US. You see whole swaths of the economy shut down. You see schools are shut down. About 22 million jobs were lost. That's 3 times more than the great financial crisis. And then you look at the stock market and you go, what is going on? How's the stock market up so much when the real economy is experiencing so much carnage? The mistake is assuming that the stock market is a data-based mechanism. You throw in a bunch of economic numbers and then it's going to spit out the right stock price to match those numbers. Now, it seems logical, but it's wrong. This is what Howard Marks in his book, The Most Important Thing, would call first-level thinking. First-level thinking is simplistic and superficial, and just about everyone can do it. All the first-level thinker needs is an opinion about the future, as in the outlook for the company is favorable, meaning the stock will go up. First-level thinking says, it's a good company, let's buy the stock. Second-level thinking says, it's a good company, but everyone thinks it's a great company, and it's not. So the stock's overrated and overpriced, so let's sell. Second-level thinking is deep and complex. And if we step back and try to do some second-level thinking about the dichotomy between the stock market and the real economy, then it might start to make sense where we are right now. So let's consider the following. The future. Markets do not focus on pricing present conditions, but rather on discounting potential future outcomes. After the coronavirus sell-off at the beginning of this year, the market was pricing in a Great Depression. The market was down over 34% in about 23 trading days. And after that, the Federal Reserve went on its most aggressive monetary policy in history. It injected a lot of liquidity into the system. And the market went from pricing that Great Depression to pricing in a short-lived recession. And they also threw in a little bit of hope for a vaccine coming sooner rather than later. So from those lows, the market is up over 38% as of the end of June. Number 2, liquidity. The Fed easing that we just talked about resulted in a massive injection of liquidity into the system. You add on top of that the fiscal stimulus, and people had a lot of excess cash that they used to pay down debt or that they were just saving because they couldn't go out and spend it. And so the market is discounting that excess liquidity in the system that at some point in the future, the consumers and businesses are going to put that capital to work. Number 3, TINA. There is no alternative. Part of the aggressive action was taking interest rates all the way back down to zero. So with that excess liquidity, if you're looking to put it to work in something to get some sort of return, really there's no alternative except stocks. You can get dividend yields, you can get some price return. So this created that there is no alternative except to put the money into stocks. So a forward-looking market, a lot of liquidity, people looking for some return somewhere, that's all those things have created a bullish environment for the stock market. And if we're Rip Van Winkle and we're just reading the headlines, yeah, you would rush to your computer and you would hit the sell button. But when we step back and do that second level thinking, we can see there's an underlying trend that creates that bullish market environment and really kind of describes why we have that dichotomy between the stock market being up while the real economy is suffering. Now, this is really important. None of this means that's blue skies and smooth sailing ahead. All this does is just tell us where we are right now. How do we get to this moment with the stock market being up, while we have so many people unemployed, while we have a lot of small businesses going under? In our Q2 letter, which I made a video of and you can watch right there, or you can download it down in the description, we talked about how a bear market usually has 3 stages: duration, frustration, and capitulation. Well, this bear market did not have duration. This is one of the quickest bear markets in histories, with one of the quickest recoveries in histories. What we did have was frustration and capitulation. People during those March lows were really frustrated and really scared that things were going to happen with their money, and so they were selling out of stocks while the market was going down. Because we didn't have the washout and that duration from this bear market, and those major themes that were working before are still working, some of them have reached valuation points that are so extreme that we haven't seen them since the late 90s, like growth over value. But the lesson from the bear market at the beginning of this year, and the lessons just from the past in general, is that what has happened in the past doesn't mean it's going to happen again in the future. So while these major themes are still working and we still have positions in those themes, we're starting to find value in those overlooked asset classes or those overlooked factors. For value, for instance, we're starting to put some capital work into value indices. For the first time in a really long time, we're putting capital work into small cap names. We're still adding money to emerging markets and foreign developed markets. We also made a small sector bet in the oil and gas sector. They really got beat up during the coronavirus sell-off and before that. You had kind of the trifecta of headwinds. You had a glut of supply. We had kind of the pricing war between Saudi Arabia and Russia that produced that big glut of supply. You had, when coronavirus hit, people started working from home, so demand for oil and gas dropped off. And then you also have that long-term trend of people moving away from fossil fuels to more renewables. Now we think the first two, the glut and the work from home, those will be self-correcting. And we saw some real value in these assets, and there's this beat up sector, so we put a small position into the oil and gas sector. And then in fixed income, we're staying short-term and high quality. High yield, there was an opportunity in that sell-off that you can pick up some really attractive pieces, but because of the Federal Reserve's actions, those prices have come back up. Now, we don't think the Federal Reserve can backstop every over-levered company out there, and so every piece of high yield is not safe, but the price doesn't give us enough reward for the risk we're taking by moving down in quality to those high yield bonds. We also view short-term and high-quality fixed income as a source of volatility control and also a source of liquidity. So if we don't have blue skies and we have another market sell-off, we can shift money out of those high-quality short-term fixed income and move them into those riskier assets when the rewards justify the risk. If you want to read our full letter to clients, the Q3 letter, there's a link down in the description where you can do that. And if you want to learn more about our portfolio management, then watch this video from our Q2 letter. If you've already seen that, you can watch this video. And if you like these videos, please hit subscribe. Until next time.